What is going on, traders? In this video, I want to cover something that I feel like is not being covered enough in the trading community. And I did get a question about this from one of my elite members, who is actually an aspiring trader, who's achieving great results in backtesting so far, but asked me the question, hey man, how am I going to be able to become a full-time, a consistent and profitable trader when I only have a few hours a day to spare on trading? I cannot simply trade full days, is what he said. Is it still possible for me? And the answer is really simple. Yes, of course. You would, however, need to get creative, right? You would have to be creative with setting alerts, looking for certain spots on the charts, marking them out, and only taking actions and spending the time you have in between your job, in between school, during your break, whatever it is. You would need to locate certain positions on the chart, look at certain liquidity pools, certain fair value gaps, whatever your point of interest might be, set alerts there and only look at your phone or look at your PC once your alerts go off. So easier said than done, of course. Let's actually look at an example that I prepared for you guys. And it's an example of today. A lot of traders in the community actually took these trades, so that's really nice. It's really nice to see that my students are actually picking up exactly what I am seeing on the charts by themselves. So it seems like my knowledge is really being transferred to these students, which I really love to see. So in this example right here, as we can see, the Asian session was quite rangy. We were building up quite a bit of liquidity, as we can see when it comes to a support and resistance point of view. We had all of this support that was staying intact, which didn't really get taken out during the Asian session. I mean, don't look at London just yet. To add to that, we had imbalance right here to fill right here. And let's actually look at the remaining imbalance as soon as London hits and talk about exactly that. All right, so imagine that you want to trade London. You are going to spend, let's say, before the job begins, or you're just going to take a 15-minute break. You're going to do this like 5 minutes before the London session opens. You're going to start doing your markups, right? Let's quickly go back in time and see what you would see. All right, so the London session is about to open. You are doing your analysis and you mark exactly this. You mark the fair value gap right here. You mark the liquidity on the sell side that we have here. And you also mark the liquidity that we have on the buy side right here. What's also worth noting is that we have a nice FEG right here. So for buys, this is going to be our point of interest. If we get a confirmation with, let's say, the ICT 2022 model, and for sells, we are interested in sells right here. Now, let's say price first goes to the highs. Would it be smart to all of a sudden target the lows? In some cases, not, right? We really need to take external and internal liquidity into account. And I will clear that up once we get to the examples, right? Okay, you've got your alert set. So your first alert is going to be right here when this FEG gets mitigated and this liquidity is taken out. And your second alert is going to be set right in this fair value gap right here. So of course we have our positions on right now. I don't really see the point in letting price play, knowing that I've seen it before. I made the video anyway, so I'm just going to be transparent. I'm just going to say, just cherry picked this specific example in the London session, just to give you an example of how you could trade with alerts. So right now the London session opens. Let's say you're still in your break. Your phone makes a ding, boom, it notifies you that your liquidity is taken out. So what you'll likely do is you start eyeballing your phone, right? You see that this low is being created. So what do? You set a new alert and you can put your phone away again. Right here, you set an alert at the high of this candle. And once that candle breaks, we know that we have a market structure shift. So you put your phone away. Now the next ding comes along, right? Bing. Your phone goes off and what do we see? You grab your phone and you immediately notice that right here, we have a breaker block and we also have a fair value gap. So those are two strong confluences for a potential entry. Now, let's say you were targeting, you could be going as target for the FEG right here, or you could be going for the low hanging fruit, the high from the Asian session. We mapped out this FEG right here. So let's actually go with that. You set your order, you put your phone away, and this is just a set and forget trade, right? Your next alert, where is that going to go? Where are you going to be taking action? You're not going to be setting an alert at the low here again, right? Because we just took out liquidity. If price now were to return to this low, that would indicate that price is likely going to look for even lower points. So if you are still interested in the sell side, I would put an alert right here. So you could set one right there. Where should your next alert be? Your next alert should be at your take profit, because you believe that that might be a possible flip zone, right? Where price might actually be looking to retrace back down again. So let's see if we get filled here. Price has really nice displacement and we start moving upwards. And this all while your phone is of course in your pocket. Now, bing, your alert goes off once again. What did we do? We took out major liquidity from a session. So we took out a session high. We're starting to see a reaction, but we do not really have a market structure shift or a decent sweep just yet, do we now? Now, right here, we have an aggressive move to the upside, taking out the liquidity, completely filling up the imbalance that we had right here. And we also have strong displacement to the downside. So when it comes to alerts, your alert goes off right here. You are, let's say, every minute checking your phone, quickly looking at what price is doing. This can be while you're working, while you're in class, still paying attention. You have your sweep of liquidity, right? So at this point, you know that if price is going to reverse now, this would be the place where market structure shift is at. Right here, what do? You set an alert at the low. Then minutes go by, ding, your alert goes off, and you can start looking for a fair value gap. Now, an approach that I really like is starting on the 5 minute and working your way down to the lower time frames. So here we have one on the 4 minute, and higher up we have one on the 3 minute. And then on the 2 minute, we have this one, which I really like. I like the displacement it made. This right here is a clean move. We also have reverse FEG or an IFEG, an inverted FEG right here, which is also a confluence. So this would be where I set my limit order. I would cover the high. You simply set your order because you had your market structure shift. I always praise to go for closures below. In this case, we do get that, so that's good. You set your position. Where do you set your alert? Right here at the low. You get tagged in and price immediately brings you to your take profit. Kazam. And why did we target this? That's something I wanted to touch upon. If we think that this is going to be a sweep of liquidity, then it's really unlikely that price is going to ping pong between major liquidity targets, right? It's much more likely that if we are going to take this out, that we are going to take this out in another session, right? This is probably going to hold as our session low. You don't often see that price ping pongs in between the high and the low unless we are really rangy in a London or a New York session, right? So in this case, what do? You basically target liquidity that is more of an internal nature. This was the most extreme internal liquidity. Plus we had our additional confluence being our fair value gap right here. And that's it, right? Honestly, if I win 2 trades like this, I would be done for the day. All in all, let's say you did your analysis, which takes around like 5 to 10 minutes. I would say more 5 minutes. If you have to look way longer than that, then I think you're overcomplicating things. So 5 minutes for the analysis. Your alert went off, you had to wait. This was the alert. Okay, so let's say another minute to set an alert at the top here. Your alert went off. You set your position. You set a new alert. Let's say all in all, that also takes 4 minutes. You hit your TP. A new alert goes off. You monitor price. Let's say you monitor price for a good 8 minutes here, right? Like, and this is if you're not done after this specific trade right here, right? If let's say during the AM session, you can only free up 15 minutes, then only free up 15 minutes and take one trade, and then try to free up another 15 minutes during the New York session, right? I think you get the idea. Now, another way of tackling this, which I see a lot of people do, is instead of waiting for the sweep and waiting for all that stuff to happen right here, what you could also do, and let's actually go for another London session right here. Something you could do is take price back. Right now, around the 15 minutes, we have a bunch of liquidity, but we do not really see a fair value gap. Let's see if we have one on the 5 minutes. Yes, we do. So right here, for example, this whole zone, we have quite a bit of imbalance. We also have a bunch of liquidity up here. And it seems like we are taking that out. So our next logical target would be this imbalance right here. Let's say you set an alert in that imbalance, your alert goes off. Now what happens? We wait till we get a confirmed setup. And in this case, we can see a nice market structure shift. And I do not see this as a market structure shift. I see this as inducement. So this right here confirms a sweep. We mitigate imbalance as well. So this to me is more of a confirmed entry. Can take an entry right at the breaker block in combination with the fair value gap. So we have our two confluences here. Boom. And what do we target? Could target some of the liquidity from the Asian session right here for 4R. Covered its high. Set your alert, right? Set your alert right here. Know when you're in or out of your position. And this one right here appeared to be a win. And it's as simple as that. So your alert goes off. You see your high being taken out. You see a low form. You just eyeball your chart every 2, 3, 4 minutes. Once you see your sweep, you set your alert goes off, set your position, and just set and forget that stuff. And try to aim for one trade. If you're really busy, try to only aim for one trade. If you do have some more time to free up, try to go for 2 trades, but I wouldn't recommend more than that. Working with alerts is really simple. It's something that I do myself quite often. So what you will see me do when I come into a session, because I don't have to take a trade each day, if I see relative equal highs, this is where I would set my alert and I would simply wait for that to be taken out. So in this case, I would likely not have been taking trades in London. And now a really big point of liquidity would be this New York low right here, or this London session low right here. But the sessions are already over. And as you can see, that's where we get the strongest reactions, right? We took out major liquidity. And when the major or external liquidity gets taken out, we can see the strongest reactions. So really, you do not have to eyeball the charts 24/7. You do not need to stick to the 1 minute the whole time. Just use a higher time frame, the 15 minutes, the 5 minute, the 1 hour, to mark out the targets or the POIs that you think will have relevance. Wait for a reaction. If you don't get a reaction, just continue with the day. You do not need to eyeball the charts and chase an entry the whole time. This will just cause you to lose. And also this approach, if you are a full-time trader, if you do have the whole day to be looking at charts, this way you're able to monitor multiple pairs without being stressed out, without missing certain entries. And honestly, I think trading with alerts is just much more lucrative than eyeballing one single pair on the 1 minute to the whole day, forcing yourself to take a bunch of positions, which will likely to turn out to be losses because you are likely dabbling around in the mid of a bunch of liquidity pools and are going to become the liquidity. All right, I am going to end the video here. I do hope you found some value in this. If you did, make sure to hit the like button. I would appreciate if you subscribed, and I think you will also find value in that. And if you have any remarks related to this video, feel free to leave them in the comments. I'll be more than happy to check them out. You can also check out the free Discord link in the description. Cool guys, thanks for watching.